Alright guys, so we have big economic updates for you. The Federal Reserve has made a stunning admission that we all saw coming. The Fed rate hikes are over and everyone's waiting for the first rate cut to happen. But Powell, he has crushed the hopes of the bulls. In the latest FOMC meeting, Powell told the world that rate cuts in March are not the base case, which means interest rates will stay higher for longer. And consider what happened over the past few weeks. US Q4 GDP came out hotter than expected at 3.3%. The jobs report saw an increase in job openings by 250,000, so at least on the surface, the economy looks strong. According to Powell, this is a good situation. This is a good economy. Unemployment is under 4% and inflation seems to be coming down. If that's really the case, then there isn't a need to drop interest rates anytime soon. Remember that the Fed is all about crushing inflation. It's almost double their inflation target of 2%, and now we just had a rebound in December. So you throw in more inflationary risk from across the world as well. The Red Sea is a disaster zone with the US thinking of striking Iran, which could just send consumer prices higher. It's all about how sticky inflation is going to be, which is still a big issue. Looking at core inflation in the US, things have hardly moved since September 2023. We have seen at most a 0.2% decrease in Q4, which is a signal that inflation, the fight isn't over yet. We have to read between the lines here. The jobs data looks great, the economy is still being propped up by deficit spending. The superficial metrics are flashing green, and the only red light is coming from inflation. And Wall Street is finally getting the memo. From Bloomberg, Goldman Sachs, and Bank of America throws in the towel on Fed rate cuts in March. And these are the final two banks that have surrendered to reality that rates will only drop in May or June. As it stands, the markets are pricing in 60 basis points of cuts for June, which means interest rates will have to fall down to 4.8% or lower. If it doesn't, we'll see another crash in bonds and stocks as well. Remember guys, in this new brave economy, fundamentals doesn't matter anymore. It's all about market expectations. Everyone is trying to front run reality and pricing things 2 or 3 steps ahead. If inflation rebounds for whatever reason, we are going to have a really bad situation on our hands. And if you think about this carefully, the Fed is trying to crush the last vestiges of inflation. This is their final battle in the war against inflation, their final swan song. Let's look at the facts here. Firstly, by keeping rates high, the Fed is encouraging money to stay out of the economy and hide in US treasuries. And this should be the most obvious cause and effect. US money market funds have reached $6 trillion for the first time in history. That is money leaving the banks and money not being spent in the economy. By delaying rate cuts to May, June, or beyond, the Fed is trying to counter the effects of wage growth. If you just got paid, you'll think twice before spending when you can get over 5% in the markets, right? In the money market funds. Secondly, the Federal Reserve is still selling off their treasury holdings. Since 2022, Powell has been unwinding his holdings of US government bonds, and this is another form of quantitative tightening or QT. The Fed has sold almost $1.5 trillion from the peak 18 months ago. We are now back to the March 2021 level. Powell is trying to normalize the balance sheet back down. And the longer inflation remains sticky, the Fed will continue to slash the balance sheet to remove money from the economy. Remember how this works, right? When the Federal Reserve they sell their bonds, they simply delete the money from the financial system. It's just a book entry that disappears like a magic trick. Now, the third fact is to recall how the US Treasury has lowered their borrowing estimates. For Q1 this year, Janet Yellen expects to borrow only $760 billion, 55 billion lower than the previous estimate. And this shows a tightening of fiscal policy as well. Not only is the Federal Reserve removing liquidity by keeping rates high, the US Treasury themselves, they're also borrowing less money as well. And this helps to prevent long-term rates from going up while denying the economy additional government spending. In other words, they are trying to fight inflation while propping up the economy. The goal is to crush inflation, but in the short term, this is a horror story for the markets. Over the past year, the S&P has gone from 3,800 to almost 5,000 points. A big part of that is the pricing in of multiple rate cuts from the Federal Reserve. There's an enormous disconnect between what investors are predicting and what the Federal Reserve expects to happen. And it's critical we understand this. This is why the stock market has been going up higher non-stop and why this could unravel very badly. Investors are pricing in 5 to 6 rate cuts this year, but the Fed themselves only see 3 rate cuts in 2024. And if rate cuts only happen in June, it's near impossible to have 6 of them happen by December. It's really improbable, highly unlikely. And that's why the market is priced for perfection, and 37% of the market still believes the Federal Reserve is bluffing. But what happens when people realize the truth? That is the big risk on hand here. However, the market seems to be still resilient. If we look at the S&P again, we can see the crash after the Fed announcement wasn't very convincing. Yes, the market dropped by 2% after Powell's statements. Then we had this sharp rebound up by almost 2% again. It's a reverse crash up when the situation clearly favors a further drop in price. So what's going on here, right? If the market expects 6 cuts but the Fed has delayed them till May, shouldn't that be a come to Jesus moment? And this is where we need to realize what really moves the stock market. It's not fundamentals or the economy, but investor sentiment. Everyone today is trying to front run the market and price in future expectations. When you have people also trying to front run the front runners as well, it's one chaotic mess where everyone is trying to second guess each other. And there's this chart I need to share. It shows us how the stock market moves immediately after the Fed rate hikes or Fed rate cuts. Using data going all the way back to 1982, after the final rate hike, the market tends to rally by 10% on average. We have seen this since July last year. Since the Fed stopped hiking, the markets have indeed gone up by over 7%. The next part is even more interesting. It shows us a market gain of over 10% as well 6 months after the first rate cut. In fact, the market rallied by almost 16% after rates went down in 2020. Now, of course, that didn't happen after the '08 crisis, the markets did collapse instead. But is this big gain that the market is all betting on? If you and I, we know this, you can bet that every other investor is aware of this as well. Could the market crash after this big gain? Now, that part is a little shadier, right? If the Fed doesn't come in to save the day, we could have a nasty correction down. But if Powell plays God, we could see a big rebound in price. But that's down the road, right? For now, investors believe the story that the first Fed rate cut is bullish. So they're piling in more money in anticipation of the big market rally coming. That's why personally, I'm still in the markets as we speak, right? We are in an upside down world, a clown economy, a bizarro market. You want to hedge yourself against any downside, but also realize that this melt up can continue for the next 6 months. It might even last until the November elections. But we must be aware of the cracks forming in the system. We have all confidently forget about the banking crisis, right? However, there's now a brutal reminder of what might happen. The longer you keep interest rates high, the higher the odds of a new banking crisis. It wasn't too long ago that Silicon Valley Bank, SVB, First Republic, and Signature Bank, they all collapsed. And now a new bank is starting to fail. $100 billion bank is facing a terrible crisis. New York Community Bank call crash deepens after their earnings collapsed. This triggered an 8% crash in regional banking stocks. The bank suffered a horrific 40% collapse in price after revealing a 260 million loss. And guess what triggered this? Real estate loans once again. We have rents going down, but refinancing costs are going up. Throw in the fact that rate cuts won't come until May or even June. This is going to destroy the portfolio of regional banks. A ton of them still holds a lot of real estate exposure, and their balance sheets are cratering to hell. Looking at the US real estate crash, we can see how bad things are for the banks. Prices across the board have collapsed, with apartments falling by 12% and offices booking a 25% crash. By 2025, banks will be facing $560 billion in commercial real estate maturities, including offices that are collapsing. If landlords decide not to refinance and they just throw the keys to the regional banks, then that will be the end game, the end of the line. We'll have even more bankruptcies on hand. And that's why the Federal Reserve, they are playing a very dangerous game, keeping interest rates high. Yes, it is to fight inflation, but they risk triggering a new banking crisis in 2024. The New York Bank set aside $552 million in the fourth quarter to absorb loan losses, which came from loans used to finance an office building. Now project this mess across other regional banks and you quickly see credit drying up across the economy. If the regional banks stop lending money to refinance or charge higher rates, this could indeed trigger a bigger CRE collapse in the US. It might even trickle down to other commercial or personal loans in the real economy. And when credit stops flowing in this debt-based economy, we could see the real businesses really go under. And if that happens, unemployment will shoot up and openings will grind to a halt. The Federal Reserve is facing a time crisis today. They are trying to keep rates high enough to defeat inflation, but prevent a real estate implosion as well. But it's getting harder and harder to accomplish the impossible. There are really horrible signs that the US economy is starting to weaken. I have to report to you guys our bad news. Bidenomics isn't working, and the Federal Reserve might be the final straw that breaks the camel's back. And you're probably aware of the massive UPS layoffs, right? 12,000 jobs have gone in an instant because of higher labor costs and decreased demand. Let's put the labor unions aside for this one and think about the big picture for a bit here. When you have a big shipping company culling a ton of jobs, it shows that consumption throughout the country is facing serious headwinds. UPS reported a 31% drop in quarterly profit as e-commerce demand refuses to recover. And this tells us the true consumption pattern in the economy, and it isn't looking very, very good. Once again, I must remind everyone that the real economy isn't the stock market. We could continue to see a big disconnect between market prices and what's really happening on the ground. But sooner or later, reality will catch up. The longer the Fed drags the rate cut, we could see a whole pile of bad things start to happen. If we get another regional banking crisis this year, it might be systemic, and that might be enough to wake up all the investors. But let me know what you think. Can the Federal Reserve really save the day? And is a new banking crisis on its way? Is it coming? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.